If you think the hardest part of retirement is getting rich, you have already made the mistake that ruins millions of people. Getting rich is hard, staying rich is harder. Living off your assets without destroying them is harder still. Most people spend 30 or 40 years trying to build a pile of money, and then they walk into retirement with a plan so fragile that one bad year can tear it in half. They think the danger is the market going down. It is not. The danger is needing cash while the market is going down. That is when a portfolio stops being a portfolio and starts becoming inventory for liquidation. I have seen this mistake in 100 different costumes. A man says he owns solid companies. A woman says she has a balanced account. Another says he has enough because the spreadsheet says so. Then the market falls, the bills arrive, the account is red, and suddenly they are not investors anymore. They are forced sellers. They are not choosing what to do. They are obeying the calendar. That is how capital gets murdered politely, and that is why this conversation about weekly income matters much more than most people realize. A lot of people hear the phrase weekly dividend ETF and think it is a gimmick, a little financial entertainment, a novelty product for people who want their brokerage app to light up every Friday. That is the shallow way to see it. The serious way to see it is this. A weekly income stream can act like a shock absorber between your life and your principal. It can reduce the chance that you have to sell the machine just to pay for groceries, taxes, or utilities. It can create breathing room. And in investing, breathing room is not a luxury. It is survival. That is the real game here. The game is not to brag that you are getting paid every Friday. The game is to build a structure that lets you sleep, lets you reinvest faster, and most importantly, keeps your hands off the core capital when fear is everywhere. If you do not understand that distinction, you will chase yield, confuse noise for income, and get yourself skinned alive. So let me say the hard thing plainly. A weekly paycheck from investments is not automatically smart. A weekly paycheck built on a bad foundation is just a faster way to watch a bad idea flatter you while it empties your account. The right question is not how often does it pay. The right question is what is doing the paying? How stable is the engine? What is the tax leak? And what happens when markets get ugly? That is where most people fall apart. They want the Friday check, but they do not want to do the work of understanding the machine behind it. I do. And if I were talking to someone who wanted to build a serious income structure in 2026, I would start with one harsh rule. Do not build your income castle on the top floor. Start at the floor. Start where the money is dull, predictable, liquid, and boring enough that nobody at a cocktail party wants to hear about it. Because boring is what pays the bills when the glamorous stuff starts screaming. This is the part of investing that people resist because it does not feel exciting. Excitement is expensive. You know what excites me? A system that keeps me from being forced into stupidity. That is why the foundational weekly funds in this document matter. They are not there to make you feel clever. They are there to keep you from panicking. The first big idea is what I call the liquidation trap. Most retirees think sequence of return risk is a technical phrase for planners and actuaries. I think it is much simpler than that. It means bad timing can make a decent portfolio behave like a terrible one. Take two investors, same account size, same average returns over 10 years, same intelligence, same discipline. But one of them needs cash during the first ugly stretch, and the other one does not. The one who needs cash starts selling shares when prices are down. Every sale reduces the capital base. That smaller capital base then has less power when the recovery finally comes. So the investor is not just losing money in the decline, he is crippling the rebound, that is the hidden knife. The market drop gets the headline, the forced sale does the real damage. Now flip the situation. If part of your portfolio is throwing off cash every Friday, then the monthly bills are not coming entirely out of sales. The pressure on the rest of the portfolio declines. You are no longer walking into a weak market with a grocery list and a gun to your head. That is not a gimmick, that is structure. The second big idea is what I call the Friday buffer. Most people arrange their financial lives in clumsy monthly lumps. Mortgage insurance, utilities, grocery runs, random emergencies. Then they pair that real life with assets that may or may not send money at the right time. The result is friction. Weekly cash changes the rhythm. Not magically, not perfectly, but meaningfully. If income lands every Friday, then you are constantly refreshing liquidity. The psychological effect matters. The practical effect matters more. You need less idle cash sitting dead. You need fewer emergency sales. You get a steadier flow between market income and living expenses. And once people feel that steadiness, they stop doing desperate things. Desperation is one of the most expensive line items in personal finance. The third big idea is what I call the reinvestment flywheel. A lot of people underestimate what frequency does to compounding because they only see yield and ignore cadence. But time is not just measured in years, it is measured in how quickly money that has been paid to you gets put back to work. If an income stream comes monthly, reinvestment waits. If it comes weekly, reinvestment starts sooner. No, This does not turn a weak asset into a miracle, but over 10, 15, or 20 years, faster reinvestment does what it always does. It quietly widens the gap between the disciplined investor and the distracted one. Compounding does not need drama, it needs repetition. That is why I have always loved systems more than stories. A story gets you excited for a day, a system pays you for decades. Now let me get to the part where people usually go wrong. They hear all this and immediately decide the answer is to chase the fattest yield they can find. 50%, 70%, 100%. They think the market has finally invented a legal money printer. What it has invented is a fast way to identify impatience. High yields are not automatically lies, but they are often bait. And bait works because greed hates foundations. That is why I would build this in layers. I would not start with the wildest product in the market. I would start with the dullest honest one. That brings us to the weekly treasury and money market style funds described in the source material. I am not talking about fantasies. I am talking about government-backed or near government. Only structures that exist to collect interest, preserve liquidity, and send a steady check. In other words, I am talking about the kind of floor that stops your lifestyle from invading your future. One of the funds in the document is built around a ladder of treasury bills with very short maturities. Another acts like a government money market ETF under strict rules. Another takes a slightly more active approach to the front end of the treasury curve, and one of them adds leverage to long-term treasuries, which is exactly where I want you to slow down. And remember that not every treasury label means low stress. This is where intelligent investing begins. Not by asking whether something pays weekly, by asking what risk is hiding inside the weekly payment. Short-term treasury bill structures are fundamentally different from a leveraged long bond product. One is close to a cash engine. The other is making a directional statement about rates and duration. If you confuse those two, you are not investing. You are wearing a blindfold and calling it income. I would think about these four tools in the same way I think about different rooms in a house. One is the pantry. That is where you keep things that must be dependable. One is the emergency closet. That is where you keep things that must remain stable when everything else looks foolish. One is the modern workshop. That is where a capable manager can adjust faster as conditions change. And one is the upstairs balcony in a windstorm. It may give you a nice view if rates move your way, but it is not where I would put the food supply. That is the mentality difference. If I put money into a short treasury ladder that pays every Friday, I am not expecting a miracle. I am purchasing reliability, liquidity, and a living buffer between me and bad decisions. That may sound humble. Humility compounds, arrogance liquidates. Now let us talk about the first of these categories, the short duration treasury ladder mentality. When you own very short government paper, you are basically renting your money to the strongest borrower in the system for brief intervals and collecting the rent. You are not betting heavily on long-term rate moves. You are not pretending you discovered some hidden gold vein. You are harvesting dull interest from a machine that the whole market already respects. That is exactly why it belongs at the base of an income structure. If you put serious money there, the weekly payout will not look glamorous. It will look adult. There is a big difference. Children want financial fireworks. Adults want bills covered before breakfast. When the source says a position of $50,000 might throw off something like $35 to $40 every Friday in a short treasury bill fund. Some people hear that and scoff. They say it will not buy a Ferrari. Good. Ferraris are not a retirement strategy. What that weekly income can do is cover a utility bill, a grocery run, part of a gas bill, or part of a prescription schedule. And because it comes from a base that is intentionally designed to be stable, the psychological cost is low. You are not staring at a collapsing principal every time you collect the check. That matters more than people think. The next category is the money market style idea. I like this category because it solves a problem people do not admit they have. They keep emergency money in dead cash because they are terrified of risk. I understand the instinct, but cash that pays badly is a silent tax. It looks safe because it does not move. And then it quietly loses purchasing power while people congratulate themselves on prudence. A government money market ETF that pays weekly can turn a dead emergency pile into a living reserve. Not a speculative reserve, a living reserve. That is a huge distinction. You are not trying to turn the emergency fund into a growth engine. You are trying to make sure safety itself is not wasteful. And if that fund is invested almost entirely in cash and government securities, then its job is not to beat the market. Its job is to stay boring when the market goes insane. That is exactly the job I want it to do. If the SP drops 10% in a week, I do not need my emergency layer trying to be a hero. I need it to stand still, preserve optionality, and keep paying safety. It's underrated because you do not notice it when it works. You only notice its absence. Then we get to the actively managed short duration idea. This is interesting because rate environments move a passive ladder is fine. An active manager who can reposition along the very front end as conditions change can be useful too, provided the mandate is clear and the risk is modest. The important thing is not to mythologize management. An active short duration product is not wizardry. It is simply another tool for handling a cash-like income sleeve, potentially with some flexibility when the rate picture changes. If I were building a serious weekly income foundation, I could see the logic in splitting capital across a couple of these very short government-backed strategies, not because I need complexity for the sake of complexity, but because diversifying the implementation can make sense when the mission is stable weekly cash. And then we arrive at the trapdoor of the leveraged long treasury product. I want to slow down here because this is exactly where labels seduce lazy minds. People see the word treasury and think safe. They see weekly pay and think convenient. They see yield and think better. That is how mistakes are born. Long-term bonds are sensitive to interest rates. Leverage amplifies that sensitivity. So a leveraged long treasury weekly payer is not the same species as a short-term treasury ladder. It may still have a place, but it belongs in a different mental bucket. That bucket is not floor. That bucket is satellite. That bucket says, I have a view on rates. I understand duration risk. I can tolerate price movement. And I know this is not the same as cash replacement. If that sentence does not sound like the investor, then the investor has no business building size there. This is one of my oldest rules. Never let a word in the product name do your thinking for you. The market is full of products whose names sound safer than their behavior. Read structure, read exposure, read sensitivity, then decide. Now I want to talk about the tax leak, because income without tax awareness is just another way of paying tuition to the government. This is where many people get sloppy. They see weekly payments and they focus entirely on the cash arriving. They do not ask how the cash is characterized, how it is taxed, where it should be held, or what hidden edge they may be giving up by placing it in the wrong account. That is amateur hour. If the cash coming from these treasury-heavy funds is ordinary income rather than qualified dividends, then you are not getting the lower capital gains style treatment. You are paying your regular rate that can be painful at high brackets. So the intelligent question becomes, what account should hold this? Another intelligent question is, what is exempt at the state and local level because of the treasury exposure? That second question can matter a lot if you live in a high-tax state. A mediocre investor sees a 4% type yield and writes it down. A better investor asks what the after-tax, after-fee, after-friction yield actually is. That is the yield that feeds your life. Gross numbers are for salesmen. Net reality is for owners. If treasury-heavy weekly income is generally exempt from state and local taxes, that can quietly improve the real result versus a plain high yield savings account or a corporate bond product that looks similar on the surface. These small differences do not impress people at dinner. They do impress me because over time they are the kind of edges that build durable wealth. You do not get rich from one giant decision. You get rich from 1,000 small ones that stop leaking. Now let me tell you how I would frame the whole structure. If I were explaining it to a family member, I would say your portfolio needs a floor, not just a dream. The floor is where you place the capital that exists to keep life moving without forcing sales. The floor should be safe, liquid, and psychologically quiet. It should generate weekly cash if possible. It should not need heroics. It should not require perfect timing. It should not flatter your ego then. And only then do you build the upper floors, growth, higher yielding instruments, more specialized option overlays, more cyclical pieces, more volatile pieces, perhaps the tech income layer the source alludes to in later parts, perhaps selected risk capital for aggressive yield. Fine, but not before the floor exists, because when people skip the floor, every upper floor decision becomes contaminated by fear. They say they are long-term investors. Then the car breaks down, they say they will never sell low. Then a medical bill arrives, they say they can handle volatility. Then 2 bad quarters stack together and the cash account thins out. All of a sudden, philosophy disappears and circumstance takes over. That is why the floor comes first. I do not care how exciting the top floor is if the ground level cannot hold the house. The source mentions a 3-tier blueprint. I like the spirit of that because it recognizes hierarchy. Too many people build portfolios like a junk drawer, a little of this, a little of that. A high yield thing they barely understand, a speculative fund because somebody on the internet said it was genius. Then they call the whole mess diversified. Diversification is not the same as disorder. A smart portfolio knows what each dollar is supposed to do. Some dollars are there to defend, some are there to compound, some are there to speculate. The tragedy begins when defensive dollars go speculating and speculative dollars get assigned the job of paying the electric bill. That is backwards. And backward portfolios create backward lives. So if someone asked me whether weekly pay ETFs can be useful in 2026, I would say yes, but only if they are used with discipline. Use the low-stress government-backed layer as the lifestyle floor. Use it to reduce the need to sell. Use it to create weekly liquidity. Use it to reinvest faster when you are accumulating. Use it to stabilize your psychology when you are distributing. But do not worship frequency alone. A terrible product that pays every week is still terrible. A sensible product that pays every quarter is still sensible. Frequency is a tool. Structure is the truth. Now let me give you the identity shift that a lot of people need. You must stop thinking like a yield hunter and start thinking like an income architect. A yield hunter asks, what pays the most right now? An income architect asks, what pays reliably? What survives stress? How does it fit into the hierarchy? What taxes apply, and what does this allow the rest of my capital to keep doing? That second person lasts. The first person usually has a fascinating 6 months and an unpleasant 2 years. If you are still working and building, weekly cash can be reinvested. That accelerates the flywheel. If you are retired or semi-retired, weekly cash can reduce drawdowns from your behavior that preserves the machine. If you live in a high-tax state, the state tax angle can matter. If you are tempted by leverage, the floor reminds you not to confuse a tactical view with a living expense strategy. It all connects. That is why I like this subject more than most people would expect. It is not because weekly pay is flashy, it is because it forces the investor to think in systems, and systems are how you keep wealth. I have said for years that the first million is not the hardest part in an absolute sense. The hardest part is turning any amount of money into a machine that does not require you to keep acting like a hero. Most people spend their lives trying to earn freedom. Then, when they finally have some capital, they structure it in a way that keeps them emotionally handcuffed. That is madness. The point of capital is not to create a second job where you are refreshing price charts every hour and praying for good timing. The point is to create options, stability, and increasingly independent cash flow. So let me close with the plainest version of the lesson. If your living expenses depend on selling assets, you are more fragile than you think. If your living expenses are partially covered by a reliable weekly floor built from strong liquid government-backed structures, you are more resilient than most people. Resilience is underrated because it is quiet. But quiet is what lets you hold through chaos. Quiet is what lets you reinvest when other people freeze. Quiet is what lets you treat market declines as events instead of emergencies. And emergencies are what destroy compounding. If I were starting to build this today, I would not begin by fantasizing about giant yields. I would begin by deciding how much of my financial life needs a floor. Then I would build that floor with tools whose job is clear. Then I would respect the taxes. Then I would separate the floor from the reach. Then I would let Friday do its work. A weekly paycheck is not the miracle. The miracle is what it prevents you from doing. It prevents panic sales. It prevents lifestyle stress from invading your best assets. It prevents idle cash from sitting uselessly. It prevents the lie that income has to arrive in large, clumsy monthly chunks. It gives you rhythm. It gives you flexibility. It gives your capital a better chance to remain capital. Instead of becoming emergency spending, that is the real wealth hack, not getting paid every Friday, being able to keep owning the machine on Monday.